Hello everybody and welcome to my channel. In this video, we are coming to continue our discussion on consolidated financial statements. If this is your first time on my channel, kindly subscribe to the channel and hit the notification button so you can receive new videos as and when they are released. And in my previous videos, I have begun a series on consolidated financial statements, and I am considering complex groups. And so in this video, I'm going to continue from those two videos. In my previous videos, I have demonstrated the difference between vertical group structures and D-shaped, or what you call the mixed group structures. And then I also introduced the 5 standard workings that are required to solve any consolidated financial statement question. And so in this video, we are going to do a quick recap of those standard workings. And the focus of this video is to actually explain some of the reasons behind the treatment we give to certain items in these workings, especially goodwill, computation, non-controlling interest, as well as the group retained earnings. Alright, so let's get going. So I made it clear that to solve any consolidated financial statements question, you need these 5 standard workings to be able to get started. So the first one that we looked at was the group structure. The group structure for complex groups, we are talking about whether it is a vertical group structure where the parent buys shares in a subsidiary and the subsidiary also buys shares in another subsidiary. Okay, I have explained that in my video, the vertical group structure, and we also have the mixed group structure where the parent buys shares in a subsidiary and the subsidiary also buys shares in another subsidiary, and the parent also buys shares in that same subsidiary. So I have explained that one too in my previous videos. So that is what we call the group structure. So the group structure is just talking about it depicts the relationship between the entities making up the group. The entities making up the group. So that is what we call the group structure. Then the second working is the net assets schedule of each subsidiary. So with the net assets, we know that this particular working contains, as the name goes, the net assets of the subsidiaries that are within the group. So, and this is named after the accounting equation, which we all know to be assets being equal to equity plus liabilities. And so when you change the subject, when you make a change of subject by making the equity the capital, this is going to be assets minus liabilities being equal to equity. And so the asset minus liability is what we call the net assets, which is also known as the equity. So what this particular net assets schedule contains is the equity portion of the subsidiaries balance sheet or the statement of financial position. So in a typical question, you find your share capital, you find your share premium, retained earnings, other components of equity within the capital section of the statement of financial position. So those are the items we pick to construct the net assets schedule. And then the net assets schedule is also there for us to know the value of the business. So we want to know the value of the business as at the time we were acquiring the subsidiary, as well as the position of the business at the reporting date. So we have two columns. We have the net assets schedule, or the net assets of the subsidiary at acquisition date, at the time we were acquiring the business, and then also the net assets of the business at the reporting date. Then we want to know the post acquisition movement within these assets. So what we do here is that we take the particular net assets item from the reporting date, and then we subtract the value at acquisition date to get the post acquisition profit. Alright, so that is it. And then another thing we do here after getting our net assets items is that we also adjust for any item that may affect, or that should have affected, the net assets item. For instance, retained earnings. So what we do is that if there is any item that will affect the retained earnings, the post acquisition retained earnings of our subsidiary, then we bring it here. So when you look at it, some of the most common ones that we see is fair value adjustment of non-current assets. So if there is a fair value adjustment of a non-current asset item, that would would imply a depreciation issue, and we know that depreciation is used in calculating our profit. So it's an expense item that affects our profit, and so we bring it here. And then we also have a provision for unrealized profits. So if the seller is the subsidiary, we bring that provision here. The reason why we bring it here is because we want to eliminate every item that, or every transaction that transpired between the parent and the subsidiary. So provision for unrealized profits on any inventory that has been sold to the parent would have to be taken away, because consolidation is, what we are basically trying to do is to present the financial statements of the group, which comprise a parent or an acquirer and an acquiree, and then we are trying to present their financial statements as a single economic entity. So we cannot actually sell to ourselves. So as far as consolidated financial statements are concerned, the parents and the subsidiaries are seen as a single economic entity, and this is opposed to the legal entity concept, which says that the firm is distinct from its owners. So even though each of the firms are legal entities distinct from their owners, from the consolidation point of view, they are seen as a single economic entity operating as a single entity, and so we cannot sell to ourselves. So whatever the seller or the sub sells to the parent would have to be taken out, so that we can know the true and a fair view of the financial statements. So this is why we subtract the provision for unrealized profits. And the reason why we take the profit element of any transaction, maybe a sale of an inventory, the reason why we are taking the profit element out is because of the concept of conservatism, which states that accountants must take into account all possible future losses, but are forbidden from accounting for any possible profits. Okay, something like that. So that is another reason why we are interested in the profit element. All right. Now, the third working we are looking at is goodwill, and for goodwill, it is governed by IFRS 3 business combinations. So that is what we refer to whenever we are dealing with goodwill. And so the standard actually defines what a business is, what constitutes a business. And to summarize, it says that a business should have three things in place, and those things include inputs, processes, and then outputs. So what it is saying is that the inputs are economic resources that must have been transformed by the processes that are in place to be able to convert them into outputs. So that is how it defines a business, which means that it is not every um, acquisition that constitutes a business, or it's not every entity that constitutes a business. Some could be financial instruments or investment instruments or something like that. So it's not everything that constitutes a business. So the standard has actually defined the criteria for recognizing an entity as a business. And from this particular pro forma that we are seeing here, we can use it to define goodwill. So goodwill is the aggregate of the fair value of any consideration transferred and the fair value of the non-controlling interest in an acquiree less the fair value of the identifiable net assets of the acquiree. So that is what goodwill is. So goodwill is talking about the total value of the business, which comprises any amount we paid for the business to acquire the business, plus the non-controlling interest value in the business, and then we subtract the fair value of all the identifiable net assets of that business. So when we do that, we are um, calculating what we call goodwill. So whenever we take the value of the business and less the amount you paid for the business and less what the business is actually worth, then we have goodwill. Now, so this is what we have here. So we have the fair value of consideration. So it's actually consideration transferred, and people also call it, or another way of calling it is the cost of investment. So the amount of money we paid to acquire the business. And then we add the fair value of the non-controlling interest. The non-controlling interest is the value of the business that we do not control or we do not own. So the other part of the business that is owned by others or that we don't have control over is what we call the non-controlling interest. And then we have those two added, and that gives the actual value of the business, or what we call the fair value of the business as a whole. And then we subtract the identifiable net assets of that business, and the identifiable net assets of that business as at the time you are acquiring the business can be gotten from our net assets schedule. So this is our net assets schedule, and we have at acquisition here. So this particular value here represents the identifiable net assets at acquisition. This value is what we are seeing here. So how much did we pay for the business? How much does the non-controlling interest in the business uh, cost? We add those two together to get the value of the entire business, and then the value of the assets of the business is actually this. So if this exceeds the actual value of the assets of the business, then we have what we call a positive goodwill. So we have what we call a positive goodwill. And according to IAS 36, which talks about impairment of assets, uh, goodwill is supposed to be tested for impairment annually. So impairment is defined as the amount by which the carrying amount of an asset exceeds its recoverable amount. And the recoverable amount, we are talking about the higher of the fair value of an asset less cost to sell and the value in use. So that is how we calculate for recoverable amounts. The recoverable amount is just talking about the amount we are likely to get for the asset when we are to sell the asset today. So how much is the asset being recorded in our books? That is the carrying amount. How much are we carrying the asset in our books? If we are to sell the assets today, how much will it cost? So if the amount we are having in our books exceeds the amount we will receive um, for the to sell the assets today, then we have what we call impairment. So goodwill is always tested for impairment. We allocate impairment to goodwill because goodwill, according to the standard IAS 36 impairment of assets, states that impairment should be allocated against goodwill before any excess impairment is allocated to other assets on a pro rata basis. So we first of all allocate the impairment loss to a goodwill before we allocate the remaining impairment to the assets within a cash generation unit. Now the focus of this video is not actually on the other standards, so but I'm just trying to explain the figures why we do certain things that we do in these 5 working standards. All right, so that is it about our goodwill. So what is goodwill, or how do we calculate our goodwill? We have our fair value of consideration transferred, which can be a share exchange, which can be a cash payment, or any equivalent means. And we add our fair value of non-controlling interest, the fair value of non-controlling interest. And the standard also says that the fair value of non-controlling interest could be obtained by the fair value method or the proportionate share of the identifiable net assets at acquisition. So that is how the standard prescribes the measurement of non-controlling interests. So we can either use the fair value, which is always given in a question. So they will tell you that the fair value of the non-controlling interest is this. So that is the fair value method. Or you can also use the proportionate share of the non-controlling interest of the net assets at acquisition. So if that is the case, what we do is that we apply the non-controlling interest percentage on this particular value, which is the net assets at acquisition value. So this is what we get, and then we add those two together to get the value of the business. We subtract the fair value of the net assets at acquisition to get what we call the goodwill at acquisition. Then if the goodwill suffers any impairment loss, we subtract that impairment loss from the goodwill at acquisition to get the goodwill at reporting date. So this is how we calculate our goodwill. Then there's the 4th standard working is the non-controlling interests. So as I said earlier, the non-controlling interest is that portion of the business that is owned by others and not the parents. So let's say the parent acquires 80% of the subsidiary. The rest 20% is the non-controlling interest. So this is how we calculate our non-controlling interest. We have the fair value of the non-controlling interest at acquisition date, and this value is the same value we have when calculating our goodwill right here. right here. All right, so we have that value, and then we will add the non-controlling interest percentage share of the post-acquisition profit, which we have in our net asset schedule. So this particular value here. So what we do is that we will subtract um all these values from all these values to get our post-acquisition movement in our net assets, to get the total post-acquisition reserves or the post-acquisition profit. So that is what we share between our non-controlling interest and the group. So that is what we have here. And then if goodwill is impaired and we are using the fair value method, which mostly is given in the question, we will share the non-controlling interest. We will share the impairment between the non-controlling interest and the group as well. And that is what we call the full goodwill method. The full goodwill method. Those things are actually, they are mostly stated in questions. So when you see the question, you say the goodwill is to be measured at full goodwill. That means that we are using the fair value um, of the NCI and not the proportionate share. So those are some of the tricks that I want to share. So we have that, and then we'll subtract it because impairment is a loss. We'll subtract it to get our non-controlling interest to be reported in the consolidated financial statements. And then the last working is the group retained earnings. So our last working is the group retained earnings. So we begin by taking 100% of the parent's retained earnings, and then we would add the share of the post-acquisition profit of each subsidiary that the parent controls. So we have it there, and then we'll also have the share of the group of any impairment loss we have here, and then we have the provision on unrealized profits, provision for unrealized profits if the parent is the one who sold to the subsidiary. So in the net asset schedule, we said that if the subsidiary is the seller or was the seller, then we calculate the provision for unrealized profits and we treat it in the net asset schedule, because the net asset schedule represents everything pertaining to the subsidiary. So if the subsidiary is the seller, we treat that transaction within the net asset schedule. But where the parent is the seller, we treat the item in the group retained earnings, because the retained earnings actually is calculated from the perspective of the parent. Alright, so and then we have that, and then we have the group share of any excess depreciation. Group share of any excess depreciation, and that is mostly associated with associates, where we have associates and other items. Alright, so we will add that because it's an excess depreciation, it has reduced our profit more than necessary. So what we do is that we add it back. So we will have our total group retained earnings. Alright, so in this video we are coming to actually solve a question, a past exam question. So this is our question here. We are going to look at it and then we'll see how we will so let's take the question. Now when you are dealing with, or when you want to solve a consolidated financial statement question, what we advise, or what is advised, is that as and when you read the question, you start working. So we know that from here we cannot actually establish the group structure. So quickly we go to the additional information or the notes, and then we will see our group structure information there. So this is the question. We have Liberty Limited acquired 75% of the shares of Glorious Limited in 2019 when the credit balance on the. Alright, so we will just come here. Group structure. The parent, which is the Liberty Limited, acquired Glorious Limited. So Liberty is the parent acquiring control over Glorious Limited. So, and the date was 2019, in 2019, and we are to prepare the accounts up to 31st December 2022. So we assume that that is 3 years. So that is 3 years, and we are acquiring 75% right here. So we are acquiring 75% of the parent of the firm Glorious Limited. And so if the parent is 25%, then the subsidiary, sorry, if the parent is 75%, then the subsidiary is 25%. So we have it there. Alright, then let's continue. So we were told that when the credit balance on the income surplus of that, okay, so we don't have any other group structure information. We go to the second note. Glorious Limited acquired 80% of the shares in Happy Limited in 2021. Okay, so Glorious Limited also acquired 80% of the shares in Happy Limited. So we have Happy Limited here, and that was 2021. Hence, we have 2 years, assuming it was in January, where the acquisition happened in January. That will be 2 years, and we acquired 80% there, and so the non-controlling interest is 20%. Good. So this is how we deal with consolidated financial statement questions. As you read, you work, because you actually don't have enough time in the exam room to read through the entire question before you start solving. So you read, you know that they are called 5 standard questions and 5 standard workings. So in every consolidation question, you would see these 5 workings always holding. They always hold. And so what you do is that if you find an information that is relevant for your group structure, quickly draw up your group structure so that you can beat up time. Alright, so this is what the information we have on our group structure. And so Liberty acquired 75% of the shares in Glorious Limited, and then Glorious Limited also acquired 80% of the shares in Happy Limited. So what the structure depicted here is what we call the vertical group structure, which I dealt with more in my previous video. So this is the vertical group structure. And so what we will do is that we want to find our effective consolidation percentages. The consolidation percentages we'll be using within our workings. So we will have the indirect controlling interest in the subsidiary, and that is calculated as the parent's percentage in the subsidiary multiplied by the subsidiary's percentage in the subsidiary. And so we have that 60%. And so if the parent is controlling 60% of the shares in the subsidiary, then the non-controlling interest, the NCI, simply put, within our subsidiary is going to be 1 minus this figure. Okay, so I formatted it as a, so it's going to be 40%. So it's going to be 40%, and the total alt equals 100%. Okay, so this is how we actually calculate for our effective consolidation percentages. So as we go on, we will know when to use these percentages. Alright, so this is how our group structure looks like. we have our effective consolidation percentages in place, and so we can continue. So the next thing, or the next working, is the net asset schedule of each subsidiary. So let me actually, all right, so we have the net asset schedule of each subsidiary. So we have Glorious Limited. Now the first thing we are going to do is what we call, so as I said, this is built on just a change of subject within our accounting equation. So at the end of the day, we will have equity at one side, and that equity is what we have in our statement of financial position. So what I will do is I'll just link those two items to my, so we have our items here. So we have ordinary share capital, and then we also have retained earnings. So I'll just link that, and then holding my shift, I'll select, and then I'll duplicate Control D. Alright, then I'll come to my value at reporting date. The value at reporting date is what we have on the face of the statement of financial position. So we have, this is Glorious Limited. Okay, so before that, let me actually freeze these panes. So I want to freeze the panes so that when I'm scrolling, I can be able to see the names of my subsidiaries and there. So I'll select this, go to the View tab, and then I'll go to Freeze Panes, so that when I'm scrolling, I can see that this is for this and this is for that. Alright, so let's continue. That's just by the way. So we have the ordinary share capital at reporting date, and that can be found on the statement of financial position. So this is 100,000 right here. So I'll just copy it down. So that is the value for our retained earnings as well. And then also let me link that of Happy Limited. So Happy Limited is this. So I'll enter, and then I'll duplicate. So I'll duplicate, then we have that. Then the values at acquisition. So what is our share capital value? So let's go through the additional information and see what we have. So we have the Liberty Limited acquired 75% of the shares, that is the group structure, when the credit balance on the income surplus of that company was $40,000. Alright, so that is it. So that is our retained earnings at acquisition. So that is 40,000 right there. And we don't have any issue of shares. So it is assumed that at acquisition, the number of shares at acquisition, the number of shares at reporting was what was there at acquisition. So we'll just copy this using Control R. So I'll have my 100,000 here, and then we come here, it's going to be 10,000, and then we have our retained earnings at acquisition for Happy. So let's see. Glorious acquired 80%. Okay, that is for the group structure, where there was when there was a debit balance on the income surplus of that company of $3,000. So there is a debit balance on the income surplus or the retained earnings account. Now retained earnings is an equity, is a component of equity, and equity has a credit balance. So if it is having a debit balance, it means it's a negative figure. We have negative 3,000 there as our retained earnings at acquisition. And so our post acquisition profits is going to be at reporting less at acquisition. So we have 0, and then I'll copy my formula. Something is wrong with my calculation. So we have at reporting less at acquisition, and then I'll copy the formula down, Control D. Alright, so we have that. The same applies to this. So we have at reporting less at acquisition. Copy my formula down. So we have that, and then I will add everything. So this is what we have in this question. So this is our net assets schedule. We are ending there because we have another information, the third information here. So let's read the entire information. Subsequently, $500 was received by Happy Limited and credited to its income surplus of that company of recovery of a bad debt written off before the acquisition of Happy's shares by Glorious Limited. So whatever we are looking for is the post acquisition profit, whatever happened at acquisition and within the post acquisition reserve is what you are interested in. So reading this particular information, it happened before the acquisition of Happy. So before Happy joined the group, this transaction had already occurred, and so it is not, or it does not form part of the transactions relating to the group. So we will have nothing to do with it. Now let's go to the third information. During the year to 31st December 2022, Glorious Limited purchased stock from Liberty Limited for $20,000. So Glorious Limited purchased stock from Liberty Limited. Liberty is the parent. So whenever the parents sell, so the parent here is the seller because Glorious Limited purchased the stock from Liberty Limited. So Liberty is the seller. So if Liberty is the seller, then it means that we treat it under retained earnings and not under the net assets schedule. In case it was the other way around, where Liberty buys from Glorious Limited and hence Glorious Limited becomes the seller, then we would have treated this transaction under our net assets schedule. So we have that. Let's correct this. So we have that. Which included a profit markup of $4,000 for Liberty Limited at 31st December 2022. One half of this amount was still held in the stocks. So we know that this is going to be treated under retained earnings. So this is some of the tricks that are involved in solving consolidated financial statement questions so that you beat time. Alright, so we have that. So we are going to add all this together since we don't have any other information to add. So as we have seen in the standard workings, there are other items that could be treated here, but for this question, this is what we have. So I'll just do Alt equals to add my items together, and then I can copy it to the right. I'll come here, Alt equals to add my items together, and then I can copy it to the right. Then let me insert some borders. Let me insert a border at the top. This one too at the top. Alright. So that is it for our net asset schedule. The next on the list is the goodwill for each of our subsidiaries. Now we know that goodwill is the purchase consideration which we also call the cost of investment, and that is the amount we paid to acquire the business. So what amount did we use to or how much did we pay to acquire Glorious Limited? It is in our statement of financial position. So actually the statement of financial position, we have fixed assets, we have freehold property and plant and machinery. Then we have investment in subsidiaries shares at cost. And then we also have loan accounts, current accounts. We have current assets, inventories. So the current assets consist of inventories, accounts receivable, cash at bank. And then we also have current liabilities, which comprise trade payables, taxation, and unclaimed dividends, dividend payable. And we also have our capital and reserves. Alright, so we are looking for the amount you purchased, which we have already seen. So this is equal to the 80,000 here. So this is the amount of investment we made in Glorious Limited. So this is the amount of investment Liberty Limited, or which is the parent, made in Glorious Limited. So I'll just select it and then I'll link it. Alright, and then for Happy, how much did Glorious Limited pay for Happy? It's right here. So this is it. That's the cost of investment. So I'll have that. And then what we want to do is we are calculating the goodwill for the parent, for the ultimate parent. So we are calculating goodwill from the perspective of the ultimate parent of the subsidiaries. So this is the reason why we have a new item which is not part of the list of items within the goodwill calculation, but for complex groups this is a usual thing. So we have what we call the indirect holding adjustment. The indirect holding adjustment. So this is holding. Alright. So we have the indirect holding adjustment. And what we are trying to do here is that because we are looking at the goodwill from the perspective of the ultimate parent, whatever that is not related to the ultimate parent should be taken off. So this is how we do it. We want to this is the percentage the parent owns in Glorious Limited. However, Glorious Limited also owns 80% in this limited, which means that the parent owns 75% of the 80% of this amount. Okay, the parent owns 75% of the 80%. And so the non-controlling interest, what we do not control in the subsidiary, or what the parent does not control, which is the non-controlling interest in the subsidiary, is what we are not controlling in the subsidiary as well. So we are coming to use this particular percentage, which is the non-controlling interest in the subsidiary, as the non-controlling interest from the perspective of the parent in the subsidiary. So what I will do is that I will have equals this amount multiplied by the percentage that we do not control in our subsidiary, and that represents the percentage we do not control in the subsidiary from looking at it from the perspective of the ultimate parent. So we have that, and this is supposed to be negative. Okay, alright, so we have that. So for this we do not do anything because it's the parent that is controlling, that has paid for the 80,000. So what you do is alt equals, just add everything together, Control R. So we have that, and then we'll have what we call the fair value of the non-controlling interest. So we are adding the fair value of the non-controlling interest. Remember the definition for goodwill: the aggregate of the consideration transferred to acquire the business plus the fair value of the non-controlling interest. So this is the fair value of the non-controlling interest in the business. So what's the fair value? We are not giving the fair value in our question, and so it automatically presupposes that we use the proportionate share. So with the proportionate share, we are talking about um, for Glorious Limited, the NCI is 25%, which we have right here, and then I'll multiply that by the net asset at acquisition, the total net asset at acquisition, which is 140,000. I'll multiply that, and then we have 35, and then also I will have my that of Happy Limited. Now Happy Limited, the NCI in Happy Limited, from the perspective of the um, group, is this 40% we calculated. So this is 40% multiplied by the net assets at acquisition, which is 7,000 here. So I have that. Then I'll enter. So we have that, and what we will do is we'll add these two figures together. So let's add them. So we have alt equals, we add this together. So we have 115, Control R, and we less the fair value of the identifiable. So we have the fair value of the identifiable net assets at acquisition, which we have on our net assets schedule. So we are going to let it. So I'll put my minus here, and this is the net asset at acquisition. So I have that. Okay, and then also I have my minus here. I have the net asset at acquisition. We have that. So we have our goodwill at acquisition. And that is equal to the sum. So I'll sum them since this is a negative figure. So I'll just sum and then copy my formula to the right. Then let me insert a border here. So this is our goodwill at acquisition, and there is no impairment of the goodwill. So the goodwill has not been impaired, and so we leave it at that. If it has been impaired, we would have lessed the impairment from these figures. So this is what we call a negative goodwill, because the fair value of the identifiable net assets of the business exceeds the consideration transferred to acquire the business. And so this is what we call the standard IFRS 3 business combinations refers to as a negative goodwill, which is called a gain on bargain purchase. It's called a gain on bargain purchase. So let me actually put it in brackets. So we have gain on bargain purchase, or what you call the negative goodwill. So as the name goes, maybe when you are buying the business, you are able to bargain and you are able to lower the price you paid for the business, and so there is actually a gain. So what we treat, or how we treat this, is that we are going to add it to our profit. We are going to transfer it to the consolidated statement of profit or loss. But in this case, we don't have the consolidated statement of profit or loss, and so what we do is that we will add it to the retained earnings, because the retained earnings is the result of our statement of profit or loss. Alright, so we are going to do it, and then you see how it is done. Then we have our non-controlling interest. Let me put my dollar value here. Okay, so we have our non-controlling interest. So we have the fair value of the NCI at acquisition. NCI at acquisition. Let's set my there. The NCI at acquisition, and this is also done for each of our subsidiaries. So there are going to be two here. Now the non-controlling interest for the subsidiary is this. So we have the fair value of the non-controlling interest, that is this. So I'll just link it together. So this, I'll link it to this one, and then I can copy it to the right. Okay, then what we do is that we have the indirect holding adjustment once again, and this time we are going to subtract it from the subsidiary and not the subsidiary. We are going to subtract this same figure. So let me just link it. We are going to subtract the same figure from the subsidiary. Sorry, the subsidiary of the parent. So what we are saying basically is that the value of the non-controlling interest in the subsidiary includes the non-controlling interest's share of the cost of the investment in the subsidiary. So the value of the non-controlling interest in the subsidiary includes the NCI's share of the cost of investment in the subsidiary. Hence, we will eliminate this particular value from our non-controlling interest in the subsidiary. Okay, so you can feel free to rewatch this video. As you watch again, maybe the understanding might be better. Alright, so we have that, and then this is that. So I'll just add together, and then we have that, and then I'll also add, we have the NCI's share of the post. So we have the post acquisition profit, and that is equal to the, for Glorious Limited, is going to be 25% multiplied by our post acquisition profit. This is the post acquisition profit right here on our net asset schedule. So I have that, and then for Happy Limited, it's going to be the 40% multiplied by our post acquisition profit of 2000 on the net asset schedule. So we have this. So I think that is all. We don't have any other information that we can add. So let me actually insert some border here. We can see it. Another border. Alright, so that is it. So I'll just add those two together. So alt equals, select these two, and then Control R. Alright, so that is it for our non-controlling interest as well. And then we have the group retained earnings. So we start for the group retained earnings. We start with the retained earnings of the parent. So we pick 100%. So what we do is that we pick 100% of the parent So that is equal to, we can see that from our statement of financial position. So that is it. We have it there. And then we would have the group share of the post acquisition profits of each sub. So we have for Glorious Limited, and then we also have for Happy Limited. Alright, so we have for Happy Limited. So let me actually just input my, okay, so we have for Glorious Limited, and that is equal to, we are talking about the group share. So the group has a 75% share in Glorious Limited, multiplied by the post acquisition profit, which is this amount on our net asset schedule. So we have that. And then for Happy is going to be the 60% indirect controlling interest, multiplied by our post acquisition profit. So we have that. And another thing we will do here is to add, so this is where we will look at the provision for unrealized profit. So we have our provision for unrealized profits, and we can have that, we can see that in our additional information. So we have additional information here. So during the year to 31st December 2022, Glorious Limited purchased stock from Liberty Limited for $20,000, which included a profit markup of $4,000 for Liberty Limited. At 31st December 2022, one half of this amount was still held in stocks of Glorious Limited. Alright, so we are seeing that the profit element, so we are finding the provision for unrealized profit. So we are only interested in the profit element and not the entire value of the stock. So the profit element is 4,000 on the 20,000 stock that we bought from Liberty Limited, or that Liberty Limited sold to Glorious Limited. So we have $4,000 in profits, but out of this, we were told that half of the inventory remained unsold. So half of the inventory remained unsold. So it means half of the profit element is what is unrealized. And so that is what we take away. So we have the amount involved is 4,000. So actually, what we will do is that we pick the 4,000 and then we will divide by 2, or we'll just find 50% of the 4,000. So this is it. So we have 4,000 divided by 2, and that is 2,000. However, we are subtracting it from our retained earnings. So provision for unrealized profit is a deduction from our profit. Alright, so that is it for the items for our group retained earnings. However, I made it or I said earlier that when there is a gain on bargain purchase or a negative goodwill, we add that amount to our retained earnings or our profit. So we have the gain, we have gain on bargain purchase, and that is equal to the total of the goodwill of the two entities. So add them together. So add them together. So I have this amount. So we have equals this amount added to this, enter. But this is actually a gain. That is why the name is a gain. So it's not supposed to be a negative number. So let me actually put it in brackets, and so I'll bring my negative, and then I'll put the 2 in brackets so that it becomes a positive number. Alright, so this is our gain on bargain purchase. So what this implies is that our goodwill is not going to appear on the face of the consolidated statement of financial position, because it is actually a negative goodwill, and IFRS 3 says that a negative goodwill is a gain that should be added to our reserves or our retained earnings, or should be transferred to the statement of profit or loss. Alright, so but in this case we don't have the statement of profit or loss, and so we are treating it under the retained earnings, which is actually what is related to the statement of profit or loss. Alright, so that is what we have. So we have everything now. I don't think there is any other thing we will add. So we have everything there. Then we'll just sum it together. So we have alt equals. I'm going to extend it. So we have this, all of this added together. Alright, so that is our retained earnings. So we have our standard workings fully worked out. So we can now proceed to the consolidated financial statements. And remember that the provision for unrealized profits and the fair value adjustments that we do on the net asset schedule, as well as our group retained earnings, where the seller is the parent, is updated on the face of the consolidated financial statements as well. So this provision for unrealized profits, which we have here, is going to be treated on the face of the statement of the consolidated statement of financial position as well. So just take note of that. In this particular example, we have only one item that is actually like that. So if there is any fair value adjustment on current assets, we update the face of the financial statements, specifically the PPE's elements. Alright, so we have the statement of financial position, and then what we will do is, since this is consolidation, we will have our 3 entities. So we have Liberty Limited, we have Glorious, we have Happy, and then we have an adjustment column. So we'll have an adjustment column before we have the group. Alright, so we have the group. Alright, so we have that, and the first thing we are going to have here is our non-current. So we have our non-current assets. The non-current assets, then I think there are two. We have freehold property, so let me just go and link them from our financial statement of financial position. So I just come here. Okay, that's this there. Supposed to be this one is supposed to be bolding. Alright, so we have that, and I can duplicate it. Sure. So the value for Liberty Limited, let's go and link those together. So I'll go to my statement of financial position and link these two values together. I'll come to that of Glorious Limited. Glorious Limited, their freehold property, this is the amount, same 100,000. For Happy, we have this. Alright, and then what I can do is I'll just copy and then I'll duplicate it so that the other values will come. Alright, now if there has been an upward adjustment of the values of our non-current assets, we would have had them under the adjustment column. So if it's adjusted upwards, let's say the fair value of an asset or of a non-current asset exceeds its carrying amount, something like that, then what we will do is that value would have been added back, and if and then we'll also calculate depreciation on that upward adjustment, and then we'll subtract that depreciation also from the adjustment column. But we don't have those things here, so that is all we have for this. So we can actually put 00 here, and then I'll have my alt equals to sum horizontally, and then I'll double click to just click here to copy my formula down. Alright, so that is it for our non-current assets. Now you could see that we don't have goodwill because the goodwill is a negative goodwill and we treated it under retained earnings. So whenever goodwill is a negative figure, we add it as a positive figure to our group retained earnings because it is a gain to the business. It is the gain to the acquirer of the business. Alright, and it is actually a loss to the acquiree because they have lost on the value of the business. Alright, then we have our current assets. So the investments in the subsidiary are going to be eliminated. So all this the investments we have already used them already, so they are out. Then for the loan accounts, no information has been said about loans, and so the assumption is that we don't have any additional information talking about where the loan came from, but we know from the third information here that some transaction took place between the subsidiary and the parents, and so we are assuming that these loans was granted to perhaps the subsidiaries, or the loan occurred between the subsidiary and the parents or another subsidiary. So what we are going to do is that we will not deal with all of these items because they are intra-group transactions, or they took place within the same business. So we cannot actually loan an amount to ourselves So now the purpose for consolidated financial statements is actually for us to know, or for the group to reflect the true and fair view of the assets and liabilities of the group as a whole, so that the owners of the parents or the group will be able to make informed decisions about um, the group as a whole. So this is the reason why we take away everything that is within the group. So if there is any transaction that occurred within the group, we eliminate them. And so all this, the current account here is arising because of the transactions that took place between Liberty and Glorious. So we can see it here. And so we are not going to trace them, we are just going to ignore them. And that is the same as eliminating them from the books, or from the, even though these items are still appearing in the single financial statements of each of the entities as a group, these items do not matter any longer. Alright, so we have that. Then we go to our current assets. Our current assets are inventories, accounts receivable, and cash at bank. So we have, just coming to link it here. So we have equals. Then we have our inventories, and then I will copy everything to down here. Then for Liberty, it's going to be equal to our inventory amount. The inventory amount, which is $200,000. So we have $200,000. I can copy it down. And then for Glorious, Glorious, it's going to be this. Then I can copy the formula and copy it down. And then finally for Happy, it's this. Can bring it down. Alright, now an adjustment. So from the question, we are told that there has been the sale of stock. So, and there is an unrealized profit element of $2,000. So that $2,000, which we used in calculating our group retained earnings, will be subtracted from the inventories figure. So we have this. It will also be subtracted. So whenever there is unrealized profit element on inventories, on the sale of inventories, what we do is that after treating them under either the group retained earnings or the net asset schedule, depending on who the seller is, we also treat it on the face of the statement of financial position, specifically under inventories. Alright, so we have inventories there reducing by 2,000. So that is all we have here. There is no other transaction affecting these two items, and so we leave everything like that. So alt equals, and then you can copy my formula down. Okay, and then the total alt equals is that. Then we can have our total assets, and that will be equal to this plus this plus our total current assets. So I have that. Then I can insert my borders, double underline at the bottom. Alright, then we have our equity and liabilities. equity and liabilities. The first one is we have our equity, and for the equity, we have the first item, share capital. We have our share capital here, and for the equity we are taking only that of the parent. So we come straight to the group, we take only those of the parents and not the subsidiaries. So we come here, the ordinary share capital of the parents is 200,000. I'll pick it there. And then we also have the group retained. We have the group retained earnings. Now in some books you see group reserves, or you see the group income surplus. They are all referring to the same thing, but those are actually archaic terms. Right now, what the standard usually referred to is the retained earnings. So that is why I'm using retained earnings in my workings. Alright, so income surplus is actually a rare term nowadays, but it's actually accepted. So you see income surplus in questions or other books as well. So I'm going to highlight this. So we have our retained earnings, and that has been calculated for us. We have it in our standard workings right here, so I'll just link it there, and I can add these two together. So alt equals, so add them, and then let me bold this, and then what I'll do is I'll add my non-controlling. So I have my non-controlling interest. The non-controlling interest has been calculated in our standard working 4. So I'll come here and I'll add these two together. So I'll just add those two together. Then we have that. Alright, so that is our non-controlling interest. Now we come to our liabilities. So we have our liabilities. Let's bold it. So we have our liabilities, and then we can link them from our statements of financial position. So go back to my question, and then these are our liabilities. Now trade payable, so I don't know how many are there. Click it. Alright, so those are the items we have. Now let's look at them. We have our trade payables. So let me just link the trade payables for. So for Liberty, it's gonna be equal to $130. For Glorious, that is going to be equal to 40,200, and then for Happy, that is going to be equal to 800 right here. Then I can actually copy my formula down, so the other figures have come. Alright, now we have a problem here. We have the due to Liberty Limited and then due to Glorious Limited. Now these are amounts owed to Liberty Limited as well as Glorious Limited. However, we know that the transaction is between the same entities within the same group, and so what we do is that we eliminate them. So I can decide to actually remove them completely from my consolidated statement of financial position. So I can decide to eliminate them completely. So we have that. Then there are no adjustments for this. So I'll just add everything together. So I'm just going to have alt equals. And what I'm doing is I'm going to add everything together. Then I can copy my formula too. Alright. Then we have total liabilities. These are actually only current liabilities. We don't have long-term liabilities. Sorry. So I'll come here and put my total liabilities here, and then the total alt equals is this. Bold it, and then we can find our total. So total will be equal to our total equity plus retained earnings plus the non-controlling interest plus the total liabilities, and there we have it. So this is how we prepare consolidated financial statements. This is actually the third example that I have done. So the focus of this video was to actually explain the reasons behind some of the figures we see in our workings and on the statement of financial position. In my next video, I'm going to walk you through the statement of profit or loss, the consolidated statement of profit or loss, and then also joint ventures. I'm also going to look at associates. Okay, so associates and joint ventures are actually regulated by IAS 28. Okay, IAS 28. So be on the lookout for my new videos. So to do that, kindly subscribe to the channel, hit the notification button so that you can receive new videos as and when I release them. So thank you for your time, and I will see you again in the next video.